Today, I'm very pleased to introduce Maria Dramalioti-Taylor to the podcast from Beacon Capital. Welcome.
Hello, David.
So you're based in London, but your fund is relatively new. I think it's only 2020, something like that. It was founded.
Correct. Yes, we're a new kid on the block.
What's it like to raise a new fund? I mean, I like to say that venture firms are really entrepreneurs. You're going out and creating your own business. How hard did you find it? What are the challenges?
It's exactly that. It's like starting a new business, and you will have all the challenges of doing that, from getting your team together to getting the operating capital to start, or not getting, and in which case you will be self-funded, all the way to, of course, have the first closing, momentous time when you're actually getting the first closing done. It's not for the faint-hearted. There were moments of extreme risk and pain, but mostly if you believe that you have something substantial to offer to investors, it's doable, entirely doable.
New funds struggle particularly because they can't really attract the brokers, because the brokers would prefer to deal with established funds, as I understand it. So did you do all the pitches and everything yourself?
Correct. The so-called fundraising advisors or placement agents would not be interested in a new fund. You will be at best courted by the individuals who would like to make introductions, but it will be very much hit and miss. Very much like startups, you have to be at the forefront of the fundraising. So we did the entire thing ourselves. Of course, you start with a warm circle, and I can talk more about how we approach the fundraising, because we did it in a slightly different way to most new funds out there. It was daring, risky, but we are very happy that we made the effort to do it differently. So you deal with it in the same way that in an enterprise sale, you will deal with your pipeline. You take care of your funnel, you take care of your material, you have a hit list, you are trying to convert in the same way you would be converting in a corporate if you had a sales role, and you would be looking after your pipeline.
Surely the difficult thing is getting lead generation, the list of potential people. You can qualify them down. I understand that in a sales process. How do you create the pipeline in the first place?
The way we did it, first of all, we started from a warm circle. The fact that I have been investing for 10 years and I had an extraordinarily good track record in cash on cash returns helped enormously, because people knew me, and in quite a few cases they had worked with me on various deals, and they happened to be family offices, and significant family offices. So you start from a warm circle, and you're trying to get the first sort of 10, 20, 30% of your fund committed. It's the point where you are seeded. So you know that you can close, you can have a first closing, and then you can start making investments. And that's exactly what we did. We had the first closing in 2021, and within 5-6 months, we had deployed a significant part of our first closing. Gives confidence to investors that you know what you're doing, you know how do you deploy, you have the team, you have the processes, you're ready to go. We were lucky enough, quite a quick appreciation, despite what was happening in the markets, in the first assets we backed. And that helped in the marketing towards the second and final closing.
You mentioned that you approach things differently. I think everyone would start with this warm circle. You start with the people you know, and then I imagine that you build from there. But in what way was your approach different?
To explain that, I need to say that our fund is different to most European funds, because we have a mandate from our limited partners to invest both in primary investments like every other VC, put capital into the business, as well as do secondaries with the founders, offer what we call founder liquidity. Now, most big capital allocators, the likes of EIF, British Business Bank here in the UK, do not allow their funds, the funds they invest in, to invest in secondaries. They don't like that. So we had to do the entire fundraising from private capital allocators. And what we did, rather than go and raise it from individuals, high net worth individuals, and raise 200,000 from 100 people, we said, no, we'll target family offices who have an allocation for VC. We build the case for why they should go to Europe and why they should commit to our strategy of having in the same fund both primary and secondary, because it gives a particular flavor to the J-curve. So once you get your first commitment, your first closing, then you ask your investors to make introductions. That's how you essentially expand the top of the funnel.
We've had the European Investment Fund on the podcast, and it's been such a huge influence on the venture capital community in Europe. But they also won't touch first funds, really. There are exceptions, but they prefer to come in once the firm is established. So what you're saying is that it was almost an advantage that your fund is new, because you were able to offer the secondary, which definitely gives your fund a different flavor to most others. Does that mean that you would prefer, companies to have annual recurring revenues of at least $1 million, but you're perhaps looking where the risk is lower? Is that fair to say?
The fund does both primary and secondary investments, and we say that we target companies between 1 and 10 million of ARR. Just clarifying or deep diving on this spectrum, when the business is around 1 million, 2 million of ARR, we offer growth capital. We go and do a direct investment. At this point, typically they will have identified their ICP, their ideal customer persona. They will have the makings of a sales engine and a go-to-market that has provided a strong enough signal for us to analyze data. Now, on the secondaries, typically we will want an ARR of 5 million plus, and there definitely we want to see a clear path to 10, 15 million in the next 12 months. As the businesses grow, the growth rate is lowering, but that doesn't mean that we will not be looking for at least 200-300 sort of growth year on year.
What about angels? It strikes me that angels have a tough thing because they can be in very early and they might be prepared to exit at a discount on a secondary. Is that something you would consider as well?
It's not typically what we do. The reason we focus on founder liquidity is because it solves a particular problem in Europe. Founders in Europe have always been accused of taking suboptimal exits. 300 million, 400 million, they exit. When you deep dive as to why they're doing that, it's not for lack of ambition, it's because it takes a lot longer to build a billion business in Europe than in the US. Founders still have family lives, still have wives, kids. They need to take them through schooling. They need to take them to university. They need to be able to buy their first house. This is the problem we are solving. We go in, we give 2 million, and in return, what we want is their horizons to extend to 1 billion without any financial worries. That's why we prefer founder liquidity or C-level executive liquidity rather than angels. We solve a different problem, in short.
I'd like to draw a parallel for you between your business and a startup, because you're saying, first of all, it's about the team. To raise money, it has to be about the team. Well, that's exactly the same for a startup, isn't it? It's you've also got to get your go-to-market strategy right and your perfect customer, your ideal customer. So there is a parallel there, isn't there?
Absolutely, totally true. And also you need a big market. So in other words, when we looked at our offering, we looked at Europe, we looked at enterprise software because we only do B2B. We're particularly keen on data stacks, particularly keen on DevOps, but essentially anything that is B2B, it's within our enterprise software is our thesis, our target. And then we looked at what problem are we solving with the primary and secondary and how big this opportunity can be. You will not be surprised to know that the opportunity is not just billions, is 3 trillion in our estimation. So when we set out to create a new VC, it wasn't because we liked investing. It wasn't only because we like to work with entrepreneurs. It was because we believe there is an opportunity here for the large capital allocators to deploy capital in Europe in a different way to what they have done in the past, combining primaries and secondaries in the same fund.
The other thing is that, have you chosen B2B because it's more capital efficient? I mean, you need to deploy less capital to acquire customers. Is that the reason why that's a sector you've chosen?
That's a very good question. And I chose B2B because as an angel investor, it was much more capital efficient. And because I was capital constrained, but actually the truth of the matter is, as an engineer, as a management consultant, I knew digitization of enterprises. The other partner in Beacon comes from enterprise sales. We understand enterprise, we understand their tech stack, and we understand where the pain points are. So we feel more comfortable taking risk in that area rather than the B2C.
Well, Maria, thank you very much for your time. Very interesting hearing about Beacon. I wish you all the very best, and thank you very much for your time today.
Thank you, David. It was a pleasure to be here.